Welcome to the WealthStep quarterly context for the second quarter of 2021. WealthStep is an online financial guide to help people in 401ks that are 401k plan participants and other individuals make smart decisions about how much money they or you will need to retire, how much to save to make that happen, and how to invest for each life stage to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help you stay more relaxed by being informed and make better decisions towards your goals. Try to keep these presentations to about 20 minutes, and recordings will be put on the WealthStep blog. And please pass it on to people that you think that will help as well. As a reminder, WealthStep is all about these three elements: aim, save, and invest. If you do those three things reasonably well, it's amazing what you can accomplish in terms of retirement readiness and financial independence over time. So we're going to have the first section be about more topical current things, perspective for long-term decisions, markets, economy, and so forth. And the second section will be a quick review of some of the smart steps to help you make those long-term decisions well. Here, this goal chalkboard, we call it, is a good reminder to focus on the crossover of things that matter and things that you can control. And in the context of this 4-quadrant chart, the short term, the long term, what the ideal is and what's acceptable. And if you scratch this out on a piece of paper and jot things down in those boxes, it can help you focus on what matters. The key things are defining your goals, saving regularly, even when markets are down and when they're up, investing in a consistent way that might change as your age changes over time, and then again, sticking with it through different kinds of markets. Here you can see some of the news from the last quarter, or really the last year, bits and pieces of news that come out and make the market bounce up and down in the long run, as is the case shown here, and especially as you can see in this long-term chart in the upper right. Even if there's some big hiccups along the way, the long-term trend is that things head up over time. That's the nature of growth in economies. And some of the bigger news more recently was that inflation started to pick up a little bit. You may have seen that in the news a lot. There's some discussion, or many believe that that might be temporary, but inflation is unpredictable. But being a smart long-term investor is one of the best ways to combat that. Also, of course, the pandemic and CDC recommendations have changed as the Delta variant has picked up speed. So I encourage everyone to be safe and smart out there. A whole bunch of details here regarding the economy and markets. Won't read you through this whole thing. The big kind of components are that COVID is getting worse again. That could have some slowdown impact on the economy, although it doesn't seem to be having so far a big impact on the market. There's still a huge amount of money that's come through stimulus programs, direct to individuals, to businesses, through lower rates, through government mortgage and other securities buyback or purchase programs that essentially inject money into the economy. That's part of why the market's been so strong despite sort of a generally tepid economy. Unemployment remains low. That has been improving a little bit. Growth in terms of GDP, or gross domestic product, has been picking up speed, but really that's coming off of a pretty steep drop during the COVID hiccup, so to speak. And so those are some of the bigger elements, and just a reminder that stocks have been very strong. It would be normal for things to cool off. Don't try to predict when that will happen, however, because markets are not predictable. One of the best long-term approaches is just to keep sticking with it. If you try to guess what's going to happen in the market, that really can increase your risk. 1 out of 100 people might guess right, but that's just luck. in the long run, you just being in it to win it in the long run with the right stock bond mix for your age is half the game, and of course saving enough. Here you can see some of the pandemic numbers in the world, the US, and just showing California specifically. Here are numbers I'm picking up with the Delta variant. Overall, the hot spots around the world and the dark spots here, so have been lightening up where it was heavier, but still darker in the US than some other areas. And that's a little more prominent in the Midwest and the South. Oh, by the way, we managed to really avoid with pretty careful hygiene during the pandemic. That and general social distancing for many people seem to help avoid the regular flu season impacts. Now we're only a couple of months away from the next flu season, so just keep that in mind as you're out and around. In terms of some economic indicators, again, employment has improved, wage growth has improved a little bit, but still the economy not at full speed. Inflation has picked up, as you can see here, after hovering pretty low for some time. The question is what will happen next. Some expect it to cool down, some expect that it might take a little while to cool down and could remain at little higher levels for a while. Overall, consumer confidence through this sentiment index has picked up but cooled off a little bit recently. And where we are in the overall economic business cycle, depending on the country and the industry and region to some degree, but for the most part, somewhere between an early recovery and a maturing recovery or expansion. Fed rates have been hovering at very low numbers for quite some time now. If you compare back to the last 50, 60, 70 years, never been this low for this long. This is part of that stimulation. The government lowers rates, makes borrowing easier, borrowing cheaper. Companies, governments, individuals, mortgages, all those things become cheaper, which makes it easier to spend, and therefore is a mechanism to try to stimulate the economy. The Fed tried to ratchet rates up for a while, and then COVID hit and brought them right back down close to zero. So rates eventually have to go up, and when rates go up, some would think that's a good news from a savings standpoint, but it tends to also create some negative returns temporarily for bonds, given that when rates go up, bond prices go down. Here we can see markets continue to be unusually strong. So the numbers you're seeing here for the quarter are closer to what some of the projections are for a full year, with full stock year 10-year projections being around 10% per year, sorry, 7% per year. And we're seeing, 5, 6, 8, 10% here for just a quarter, and the year ranging from low 30s to mid 40s. Bonds had a strong, after a weak last quarter, this is the full year here, after a weak quarter as rates were picking up speed a little bit, not Fed rates, but market rates, bonds had a fairly strong quarter here. This is actually higher than the full year expected return for bonds, so that could get bumpy a little bit, but will never be as bumpy as stocks can be. If we look at the 4 worst markets in history, the crashes and then the recoveries, we can see the current market on an inflation-adjusted basis is far ahead of the Great Depression, the dot-com crash and recovery, and the oil and financial crisis of the 70s here in red. And it would be normal if this cooled off a little bit. No one can say when or how much exactly, but the long-term projected return is in the dotted line here, and we're way above that. And oftentimes when there's that kind of disconnection between the projected return for an extended period of time and the actual returns, there's some reversion to the mean or cooling, but remember, that's normal. What's not normal is the excessively high returns of the last 10 years in stocks. You look since the market low in 2020, some returns up in excess of 100, almost 140%. And for the last 10 years, 17, 15, 13, 12, 13, 2 to 3 times what the projected returns are in some cases. So remember, this is not normal. It was great that we got that, locked that in benefit from that. Manage your risk by having the right stock bond mix for your age and lifestyle, but don't expect those kinds of returns going forward. That is not the normal. Talked a little bit about bonds earlier and rates here. This yield curve shows the rates along the different bond maturities. The most current period here, that's called the yield curve, 630, has shifted up a little bit relative to last year and so forth. And you can see here relative to, came down a little bit relative to March, but is up from last year. All of this is to say that generally when it has a what's called positively sloping curve here, but when rates are positively sloping curve but are at the rates that they currently are, rather than moving more closely back to long-term averages, that suggests maybe a slower recovery, economic recovery, which is consistent with what's happening out there. There was an interesting survey of about 8,000 investors around the world, and here are some points. Some of this may not be news to you, but it's a good reminder of what people wish they had done and what they believe they have learned in retrospect after the part of this pandemic economy has happened. Keep spending in check, have emergency savings, have an estate plan, understand your role in your overall financial picture. For investing, avoid emotional decisions. If you've attended some of these meetings, you will know that's a common theme here. The brain works in a way that sometimes the electrical activity in the brain shifts to the smaller part of the brain that's designed for the fight and flight reflex, which is really critical if you're trying to cross the street and avoid getting hit by a car or some kind of emergency situation, but not great for long-term investment decisions. Understanding your risk, that's also important. Rebalancing your portfolio rather than letting your stock portion dramatically outgrow your bond portion over time without realizing that that increases your volatility risk. And then for those that have taxable portfolios as well, weighing in the tax consequences, there are smarter ways than others to minimize taxes. Part of that same study showed that the average investor has a much higher expectation about what returns will look like than what financial professionals do. So in the US, the average expected long-term return is almost 20% per year. And if you look at the professionals, it's hovering closer to 7 to 8% per year. So that's a very big difference, almost 3 times what professionals think and what's expected. And it's just not sustainable or possible to have returns this high for this long. And this is higher than the long-term average of the last 10 years, which is already dramatically higher than normal. So manage your expectations, manage your outcomes by being reasonable in your expectations, and you will be able to plan better and be less disappointed, and therefore increase the chance that you'll achieve your goals, because you'll realize you actually need to save more rather than relying so heavily on return, because these types of returns that just simply are not going to happen as the long-term average. This chart shows how over time it's required more and more stocks to receive the same level of return. Just a reminder of how important asset allocation is and how it takes a little bit more volatility risk than it might have farther back in the past to achieve those same levels of return. So being smart and consistent about investing is important. Now I'll take a peek at section 2, and remember there's a more in-depth full financial education video at WealthStep.com on the blog page. So as some quick reminders, key things are to focus on what matters. Keep your eyes on those retirement plan basics. Understand how your own retirement plan works if you're in one, so you're taking full advantage of the match and not throwing money away, for example. As mentioned a moment ago, avoiding emotional investing, knowing what stock bond mix is appropriate for you for your life stage, and how to think about risks. And here's what that education video link will look like on the blog. That can be helpful, and it'll talk about what the different kinds of risks are in greater detail. And investing in volatility risk is actually the one that most people think about the most, but is the only risk that really has a long-term reward, whereas most of the other risks are just risks and they don't have a reward. So you want to know what those risks are so that you're smart about which ones you take. Again, the aim, save, invest, the key elements to long-term financial independence and retirement readiness. Knowing how much to save requires having a sense about how much you're going to need to be able to stop working or work less and when you want to do that. Oftentimes, people will need to save 10 to 15% of their income, but if you start early enough, oftentimes you can save less. If you're starting later, you may have to save more. And then investing, again, by life stage is generally the best way to do it. Some of the common comments that people we meet when we do education meetings for 401k plans will say things like this. And so we're sharing this so that you can learn from them so that you don't end up saying the same things yourself. The younger people they think they can just deal with it later. You get into your early middle age and you say, wait a minute, it's not that far off. I better start saving. 50s and 60s, oh, I wish I'd started saving sooner. And 70s plus, people didn't save enough and wish they could stop working, but can't because they don't have enough retirement assets to live the lifestyle they want to live. Of course, that's not everybody, but those are some common things, and you can very easily avoid those problems by taking a few simple steps, figuring out how much to save, how much you need, and going from there. As mentioned before, managing expectations is key. The 10-year projections are some of the numbers here. Stocks close to about 7%. The long-term average for stocks going back about 100 years is 10%. So that's half of that, of what the current average investor believes they will get in the long run. And that is the projected return is lower than the average, which is half of that expectation. So keep an eye on that. Again, remember, stocks are bumpy and not everybody should be in 100% stocks, but that bumpiness has its reward over time. If you you're just to look at this segment here, you'd think, wow, it's bumpy. Maybe I'd be better to just be in bonds, 100% in bonds. But over time, even if bonds are a smoother ride, not nearly as much return, even if you have some big hiccups along the way. So oftentimes, again, having the right mix of stocks and bonds for each life stage helps you get there, and holding more stocks when you're younger and can wait out the volatility, less stocks and more bonds as you approach and go into retirement so that you have less volatility while you're actually spending or about to start spending. Here's the investor behavior study we like to reference. The market return is oftentimes 8 to 9% is a 20-year average here. The average investor, however, got only 4.3%. That's a big difference just because people were getting in and out and making emotional decisions, where if they'd just done nothing and stayed in it, would have had double the return essentially. So we call that the behavior gap, and the difference is using a disciplined process and just sticking with what's right for your life stage. This is a 100% stock example. Stock bond mix would have slightly different returns, so this is one example to pay attention to. Here's an example of the tools that will be available on WealthStep soon for those that sign up or have access to it through their 401k plans. And there will also be a free public version that's part of our way of trying to give back and help the average person who doesn't have an advisor, may not be able to afford one, still get on track and make good decisions for themselves and for their families. So take a peek here. These tools will be coming out soon. And here's a little outline for those that do sign up. Different levels. Some cases, for example, if you're a 401k plan participant, the company covers that cost. If it's a general public, for the basic version, there will be no cost. And there are options where if you want the online advice plus actual portfolio management, then there may be a small cost associated with that, depending on the size of the portfolio and so forth. And there are certain minimums that apply. So remember to create a plan, focus on what matters most, aim, save, invest,
And all of that, of course, is so that you can spend. And when you spend, you want to use a plan for that too, so that you're not spending down faster, so that you don't outlast your money. And of course, as mentioned, fighting those key risks, fighting inflation and longevity, taking on enough volatility risk, again, which is the market risk, which is one of the only risks that actually has a payoff. And again, the video will cover more of that in detail. So thank you for joining today. Appreciate your time and energy. We wish you the best of luck, and aim, save, invest.